So we did have the dollar index today falling to its lowest level since May of 2018. Longer term, it still looks like the dollar index is likely to trend lower as the Fed pledged to remain on hold as far as its Fed funds rate until 2023. Also, the next objective on the downside comes in at the 90.88 level. So I think more of the same is in store. Weaker prices for the dollar index, I think, are likely. So the crude oil market is having its best month since May. So there have been some good gains. Also, we have the OPEC Plus meeting today and tomorrow. This is a virtual meeting. So there may be more cutbacks planned as far as production. Of course, that would be supportive to the crude oil market. So I believe the trend is still intact to work higher. Also, there is the next resistance that I have coming in at the 50 to 5100 level. That is a triple bottom area that was penetrated some time ago. So I could see that objective being met possibly within the next couple of months. So higher prices seem likely for the crude oil market. So the fundamental that many traders have been looking at is, of course, the political situation. But I think ultimately it will be the interest rates that dominate, as they always have. And I think that will be supportive longer term. Of course, today we do have some pressure developing with the Chicago PMI coming a bit on the weak side. But with interest rates likely to remain low for a very long period of time, not just here in the U.S., but globally, that will be the dominant fundamental that supports stock index futures.
For the fifth time straight now, January soybeans have failed to trade and close over the $12 price level. Same about $400 meal. And people are asking, why can't we push through that price level? And I think the main reason is that it's too early. December is a beginning of the growing season for South American corn and soybeans. It'd be like our April or early May here. And so it really isn't for another couple of months that they get in the critical yield determination period for pollination for the corn and setting and filling pods for the beans. So I think that the main thing right now is that we have to kind of maybe trade a little bit more sideways than up. I still think, though, all in all, the drop in the crops potential down there will help U.S. export demand and will lower the carryout and eventually push prices higher. As far as global weather is concerned, this is usually not the time of the year in which weather is a factor for price discovery. If anything, it's on the negative side of things. But we've seen the driest November in parts of Brazil. And we're also seeing continued dryness for the most part in Russia and the U.S. Southern Plains. So I think in those three areas we have to keep watching and make sure that it doesn't get any worse. In December 10th, USDA is not expected to make a lot of changes to their supply and demand, even though people have their corn carryouts as low as 1550 for U.S. corn and as low as 100 million bushels for U.S. soybeans. It's still kind of early for them, and they haven't really seen all the export commitments that China could take from beans and corn to make any changes. So I doubt there's much changes until we get to January. So I'm looking for prices eventually, especially in January, to trade higher, and we'll see if that happens.